Everyone is wrong about XRP's price. Not the bears who say it's going to zero. Not the bulls screaming $10 by December. Not Standard Chartered who just cut their target by 65%. Not the motley fool projecting $10 on the same data. Every single one of them is missing the same thing. And in the next 20 minutes, I'm going to show you exactly what that is, what the price actually does from here, and why the people shouting the loudest numbers in both directions are working from a broken model. This is not financial advice. I am sharing publicly available information for educational purposes only. Always do your own research. Before we get into it, drop broken in the comments if you felt that the price makes absolutely no sense relative to the news. Drop patience if you think the price just hasn't caught up yet. I want to see where this community actually stands, because what I'm about to show you is going to reframe the entire conversation. Welcome back. I am the calm analyst. Around here, we don't pick sides in the bull versus bear debate. We break the models and rebuild them with the right inputs. Today, we're going to tear apart every major XRP price prediction on the market, show you what all of them are getting wrong, and build the model that actually fits what XRP is. Let's get into it. Let me set the scene. XRP is currently trading at around $1.33, market cap roughly $85 billion, down 40% year to date. 6 spot ETFs are live. A binding federal commodity classification landed on March 17th. Ripple acquired Hidden Road for $1.25 billion and is now listed in the DTCC directory for traditional finance settlement. The Evernorth SPAC is heading to NASDAQ with 473 million XRP locked in a billion-dollar merger structure. Monica Long, Ripple's president, called 2026 the year of institutional scale adoption. Brad Garlinghouse reported a record first quarter. Argentina's state-backed energy giant YPF launched $800 million in tokenized assets directly on the XRP ledger. SWIFT confirmed its global payments framework is going live with over 50 banks by June, and at least 30 of those banks are Ripple partners. And yet Standard Chartered just slashed their target from $8 to $2.80. And yet the token is down 40% through every single one of those catalysts landing. How is it possible that every good thing happened and the price went down? That is the question. And the answer is what everybody is getting wrong. The analysts covering XRP are using a price model built for a different kind of asset. They're treating XRP like a tech stock. Input catalysts, output price movement. Partnership announcement, price goes up. ETF launch, price goes up. Regulatory clarity, price goes up. That model works for equities. It does not work for a global liquidity asset that is in the middle of the most significant structural transition in its history. And until you understand the difference between those two frameworks, every price target you read, whether it's $2.80 or $10, is going to mislead you. XRP was created in June 2012 by David Schwartz, Jed McCaleb, and Arthur Brito. The design goal was specific and narrow. Build a payment settlement system that can reach finality in seconds without mining at fractions of a cent per transaction across any currency pair. Not a store of value, not a speculative asset, a bridge currency for global value transfer. The XRP ledger settles in 3 to 5 seconds. Transaction fees average 0.00002 XRP. The network has never gone down for maintenance. Hundreds of millions of transactions processed without a single unplanned outage since 2012. That design history matters because it tells you what XRP actually is. It is infrastructure. And infrastructure does not price like a growth stock. It prices like a utility that is being repriced as the market discovers its actual scale of adoption. Oil did not go from $1 a barrel to $100 because of press releases. It went there because the systems that run on oil became central to how the world economy functions. The price followed the adoption, not the other way around. XRP is following the same pattern. The infrastructure is being built. The adoption is scaling. The price is not caught up because the institutional allocation process operates on a completely different timeline than the news cycle. If that analogy clicks for you, smash that like button. This structural analysis gets buried by the algorithm. One tap helps it reach the next person who needs to understand the real model. Now let me walk you through the analyst landscape, because the width of the disagreement is itself the signal. Standard Chartered's Jeffrey Kendrick just cut his 2026 target from $8 to $2.80, a 65% reduction. His reasons: ETF inflows flattened after the initial $1.44 billion surge, institutional timelines got compressed by the macro environment, and cross-border payment adoption is scaling more slowly than his original model assumed. Those are legitimate observations. None of them are wrong. But Kendrick's model is missing the free float compression happening simultaneously. At the other end of the spectrum, the Motley Fool's Chris McDonald is projecting $10. His argument is built on the Evernorth SPAC, the DTCC listing, Monica Long's institutional adoption declaration, and a supply shock from 473 million XRP locked in the merger structure. FX Empire sits in the middle at $5, grounded in Ripple's integration with 300 banks across 45 countries. Nasdaq-affiliated forecasters are also near $5. AI models produce $6 to $8 with $10 billion in ETF inflows. And the analysis I've been running lands at $8 to $14 under the same scenario. So you have $2.80 on one end, $10 on the other, $5 in the middle. 6 different credible sources producing targets that span 350%. When the analyst spread on a single asset runs that wide, it is not because some analysts are smart and some are dumb. It is because they are all applying their models to an asset that does not behave the way any of their models assume. Now let me show you what all of them are missing, because this is the part that changes everything. The first thing everyone is getting wrong is the free float calculation. The stated circulating supply of XRP is approximately 56 to 61 billion tokens. But that number is not what is actually available to buy. Ripple holds approximately 5.8 billion XRP in operational wallets used for partnerships, market making, and ecosystem development. Those tokens do not trade on the open market. An estimated 33 to 34 billion sits in Ripple's escrow accounts, releasing up to 1 billion per month, most of which gets relocked. Long-term whale wallets with balances above 1 million XRP and near zero trading activity account for another significant portion. And then there's the ETF custody layer. When a spot ETF buys XRP, it goes into institutional cold storage. Bought, held, does not circulate. When you work through that math honestly, the XRP that is actually available to buy and sell at any given moment, the true free float, is a fraction of the 61 billion headline number. Some estimates put the actual tradable float at 8 to 12 billion tokens. Every analyst who takes 61 billion as their supply input and divides expected demand by that number is going to dramatically underprice the supply shock that happens when institutional flows accelerate. This is not a minor calculation error. It is the single biggest variable in the XRP price equation, and almost nobody is modeling it correctly. The second thing everyone is getting wrong is the timing of institutional flows. Standard Chartered cut their target because inflows slowed from $43 million per week in January to under $2 million per week in early March. They're right that the pace slowed, but they're not accounting for why. The commodity classification landed on March 17th. The SEC's ETF deadline hit on March 27th. The Clarity Act markup is targeting the second half of April. The institutional allocation process does not work on the same timeline as retail. A pension fund does not see a headline and wire money the next morning. It sees a regulatory development, brings it to an investment committee, waits for compliance sign-off, waits for custodian approval, and then executes. That process takes 6 to 12 weeks. The commodity classification that dropped on March 17th will produce capital flows in May, June, and July, not in March. Standard Chartered is measuring the rain before it hits the ground and concluding it is not going to rain. The third thing everyone is getting wrong is the market cap ceiling argument. Critics of the bull case say $10 requires a $580 billion market cap, which would make XRP larger than Ethereum, and they use that number to dismiss the target as fantasy. But this argument has a fundamental flaw. It assumes XRP's market cap will be measured against its total circulating supply forever. It won't. Market cap is a function of price times supply. If the free float compresses, and the evidence shows it is compressing, then the price required to absorb a given amount of institutional demand is much higher than the simple market cap math suggests. You can have a $60 billion circulating supply on paper, while the actual available float is closer to 8 to 12 billion tokens. At that float level, $1 billion of institutional buying does not move the market cap by $1 billion. It moves the price by a multiple of what that simple math would produce. Comment below. Did you know the free float was this compressed? Type new if you already understood this. Type new if this is the first time someone has broken down the real supply math for you. Now let me talk about what is actually happening on the ground at Ripple, because this is where the bearish case completely breaks down. Ripple acquired Hidden Road for $1.25 billion. Hidden Road is a prime broker handling institutional-grade trade execution and custody. By acquiring them, Ripple placed itself inside the DTCC and NSCC directory, the settlement backbone of the traditional financial system. That is not a partnership announcement. That is becoming part of the plumbing that processes trillions of dollars of settlement volume every single day. MasterCard integrated Ripple into their network. $9 trillion in annual transactions. Deutsche Bank committed $1.6 trillion in cross-border flows through Ripple infrastructure. Over 300 financial institutions in 45 countries on the network. RLUSD crossed $1.6 billion in market cap and is being used as collateral in BlackRock's BUIDL fund. SWIFT confirmed its global payments framework is going live with over 50 banks by June. The routing architecture puts XRP inside the settlement infrastructure of 11,000 banks across 200 countries through the Thunes connection. At least 30 of those 50 framework banks are already Ripple partners. Argentina's YPF launched $800 million in tokenized energy assets on the XRP ledger, the first major sovereign-adjacent entity to put that volume of real-world assets on the network. And then there is the Federal Reserve application. Ripple applied for a Fed master account. The OCC Conditional Trust Bank Charter approval puts them further along that path than any crypto company has ever been. If granted, Ripple becomes a federally chartered institution with direct access to the Federal Reserve payment system. The company sued by the SEC 6 years ago is applying to become a bank with Fed access. That is not a speculative thesis. That is a regulatory application in process right now. Subscribe right now, hit the bell, drop a quote, because Q2 and Q3 are the most consequential windows in XRP's history. The OCC amendments went live April 1st. The Clarity Act markup targets late April. The Goldman Sachs Q1 filing lands in May. The SWIFT framework launches in June. You want to already understand the model when the flows arrive. Now here is the honest part. Because I'm not here to replace one broken model with another. The bear case is not zero. There are 3 real risks. Risk 1, the Clarity Act, passed the House 294 to 134 with strong bipartisan support. But the Senate is different. Galaxy Digital warned explicitly that if the bill does not clear the banking committee by end of April, it is probably dead for 2026 because midterm dynamics consume all available Senate floor time after May. If it stalls, the permanent statutory commodity classification that institutional allocators need does not arrive. Standard Chartered's $2.80 assumes the Clarity Act passes. Without it, their floor drops further. Risk 2, Bitcoin correlation. XRP does not trade in isolation. Bitcoin sits near $86,000 with dominance at 60%. Altcoin season index at roughly 24. Total altcoin market cap slid from $1.79 trillion to $1.35 trillion. Liquidity is rotating toward Bitcoin, not mid-cap altcoins. If Bitcoin breaks down, the entire altcoin market faces additional selling pressure, regardless of fundamentals. Risk 3, adoption velocity versus token price. This one is uncomfortable but important. Revenue from Ripple's partnerships flows to Ripple Labs. Transaction fees go to validators. RLUSD is increasingly being used as the bridge asset in certain payment corridors, which in some cases reduces direct XRP demand. The network can grow and the token can lag. It has happened before. It is happening right now. Every metric except the price is climbing. That disconnect is real and it matters. Those are the honest risks. And any analysis that doesn't present them is selling you something. So what does the price actually do from here? The honest answer is the range is wider than any single analyst will admit. Base case. If the Clarity Act clears committee in April, if ETF approvals landed on March 27th, if Bitcoin holds its current level, expect $1.80 to $2.50 by May, accelerating to $3 to $5 through the second half of 2026 as institutional allocation processes that began in March produce actual capital flows in May and June. That is not $2.80, and it is not $10. It is a graduated repricing that follows institutional flow timelines, not the news cycle. Bull case. If the Clarity Act passes, if ETF inflows resume at the January pace of $43 million per week, and if Bitcoin recovers toward new highs, the free float compression dynamic produces price movement that the simple market cap models significantly underestimate. The $8 to $14 range that the most aggressive, credible models produce is what you get when you apply accurate free float numbers to realistic institutional allocation scales. Bear case. If the Clarity Act stalls, if Bitcoin breaks down, and if ETF inflows remain at $2 million per week, the $1.27 to $1.30 support band is the floor. Below that, $1.04 is where the bear models go. That requires 3 simultaneous negative outcomes. Possible, not probable. Now let me tie the long-term picture together, because the $1,000 conversation also needs to be addressed honestly. David Schwartz stated it publicly. XRP cannot be dirt cheap, not as a prediction, as a mathematical constraint. If XRP is priced at $1 and a bank needs to move $1 billion through a payment corridor, they need 1 billion tokens tied up in that transaction. That creates congestion. It defeats the purpose of the bridge asset. At $100, the same transaction requires 10 million tokens. Manageable. At $1,000, 1 million tokens. That is what high-throughput global settlement looks like. The velocity model shows that $1 trillion in daily cross-border volume requires approximately $1,000 per XRP to maintain system liquidity. Swift's framework just wired XRP into the routing infrastructure that handles $150 trillion in annual cross-border volume. If even 2% of that migrates to XRP's on-demand liquidity over 3 to 5 years, the velocity math stops being theoretical. $1,000 XRP produces a $61 trillion market cap on the fully diluted supply, larger than the entire US stock market. That is the honest starting point. And anyone presenting the $1,000 thesis without leading with that number is not being straight with you. But the velocity model produces a different answer than the static market cap model. And the question of which model applies to a bridge currency designed to be in transit for 3 to 5 seconds is the actual substance of the debate. $1,000 is a 2030 to 2040 conversation, not a 2026 event. But after this week, after Swift, after the DTCC listing, after the commodity classification, it is no longer dismissible. It is a liquidity math problem with a real infrastructure pathway being built in real time. Here is what I want you to take from all of this. The analysts arguing about $2.80 versus $10 are not arguing about XRP. They are arguing about which input assumptions to use in a model that was built for a different kind of asset. The correct model for XRP is not a tech stock model. It is a global liquidity infrastructure model that accounts for free float compression, institutional allocation timelines, and the distinction between network revenue and token demand. When you apply that model, the answer is not $2.80, and it is not $10 on December 31st. It is a price that follows institutional flows with a 6 to 12 week lag, rising in stepped repricing events rather than linear appreciation. Each catalyst window producing a floor that does not give back. Everyone is wrong about XRP's price because everyone is measuring the wrong thing. They are measuring the announcement. They should be measuring the money flow that follows the announcement 6 to 12 weeks later. The commodity classification on March 17th does not produce price impact in March. It produces price impact in May. The Clarity Act does not produce impact the day it passes. It produces impact 6 to 12 weeks after, when institutional deployment begins. That lag is the entire story. And neither the bulls nor the bears are accounting for it. The bulls see catalysts and expect instant price response. The bears see no price response and assume the catalyst failed. Both are wrong. The catalysts are real, the price response is delayed, and the delay is the window. The same window the institutions are using to accumulate before the flows arrive. Price is a distraction. Value is the reality. Structure is what matters. And the model that measures structure, not headlines, is the only model that will get XRP's price right. In a market fueled by emotion and noise, we thrive on data and composure. Remember, haste leads to loss, while calm analysis leads to victory. If you made it to the end, you now understand what every analyst is getting wrong: the free float, the institutional flow timeline, and the market cap ceiling fallacy. You have the corrected model. What you do with it is your decision. Comment "calm analyst" below. Let me see who stayed for the complete model rebuild, and share this with someone who is confused about why XRP keeps dropping on good news. This breakdown is the explanation they need. Like, subscribe, notifications on. I'll see you in the next one. Stay patient, stay rational, and as we always do, we don't wait for the future, we plan for it. Peace.